Welcome back to the Deep Dive. We've got a stack of documents on the virtual desk today that honestly looks a little dry at first glance.
Yeah.
It's the examiner's report for the ACCA Management Accounting exam, specifically for the period covering late 2024 to 2025.
I can almost hear our listeners reaching for the skip button right now.
Exactly. Accounting exams.
Right.
Really.
Right.
But hold on, because we aren't actually here to talk about accounting. We're here to talk about failure.
That is a much more dramatic way to frame it.
But it's true, isn't it? This report isn't a textbook. It's an autopsy. It's a catalog of human error.
Mm-hmm.
It documents exactly where smart, prepared people who studied for months, just crashed and burned.
And when you look closely, they didn't fail because they couldn't do math.
No.
They failed because of logic traps, reading comprehension issues, and just cognitive biases.
That is the fascinating part. The examiners are brutally honest in this report.
Oh, they are.
They aren't just listing the right answers. They're highlighting the psychological traps. They're showing us the gap between knowing the theory and, solving the problem.
And that applies to way more than just finance.
So that is our mission today. We're going to walk through the minefield. We've pulled 6 specific case studies from this report reel scenarios where the failure rate was high, and we're going to dissect them.
Go.
But first, give us the lay of the land. What are we walking into here?
So this is the FMA paper. It's a 2-hour exam. You've got Section A, which is 35 rapid-fire objective questions.
Right.
And you have Section B, which is 3 big multitask questions. And right off the bat, the data shows us something a bit counterintuitive.
Which is?
The split between calculation questions, so pure math and narrative questions theory definitions, is about 50-50.
Okay, half and half.
But candidates consistently perform significantly better on the narrative questions.
See, that surprises me. I would always assume math is the safe zone. Math has a right answer. Theory feels interpretable.
You'd think so. But the report suggests the opposite problem. People can memorize a definition. They can tell you what a standard deviation is in a sentence.
Yeah.
But when you give them a messy real-world data set and say, okay, apply that concept, they freeze. They just get lost in the weeds.
Well, let's get our machetes out and go into the weeds. Let's look at example 1. This is a statistical nightmare involving a company called Kenmore Co.
Right. So picture a boardroom. You've got 5 directors, and we're analyzing their salaries.
Okay.
The salaries range from $75,000 up to $110,000.
Standard corporate setup.
And the exam gives you 2 things. It gives you the raw list of salaries, and it gives you this pre-calculated number called the squared differences from the mean, which is 730.
I'm already having flashbacks to high school stats. What is the actual question they're asking?
You need to calculate the coefficient of variation to 2 decimal places.
Okay, before we even do the math, sell me on this metric. Why do I care about the coefficient of variation? Why not just look at the average salary?
That's a great question. The average tells you the middle ground, right? But the coefficient of variation, let's just call it the CV, it tells you about volatility.
The spread.
Exactly, the spread, but relative to that average. So say you're comparing 2 companies. They might both pay an average of $100. But if company A pays everyone $100 and company B pays one person $10 and another into $90K, the risk profile is totally different. The CV measures that.
Got it. It's a measure of inequality or spread relative to the size of the numbers themselves. So how do we solve it?
Well, the formula, it sounds simple. It's just the standard deviation divided by the mean.
Sigma over X bar.
That's the one. Simple in theory. But the examiners flag this as a disaster area. Where do people slip up?
It must be the steps.
It's a multi-step process. You have to hold 3 different numbers in your head. So step 1, find the standard deviation. They gave us the sum of squared differences as 730.
Right, 730.
To get the variance, you divide that by the number of people.
So 5 directors, 730 divided by 5, that is 146.
Correct. But 146 is the variance. The standard deviation is the square root of that.
Okay. Square root of 146, that's roughly 12.08. We'll say 12 for these numbers.
Right. So your numerator is about 12. Now, step 2, the mean.
That's the easy bit. Add up the 5 salaries. That totals 440 divided by 5. Average salary is 88. So we have 12 over 88.
Exactly. And here it is, the final trap. If you punch 12 divided by 88 into your calculator, you get below 0.136363.
And the question asks for 2 decimal places.
And a lot of candidates see 0.136 and they they chop off the end. They type in bill of 0.13.
But the 6 means you have to round
Oh,
up.
I have to round up. The answer is 0.14. If you type 0.13, you get 0 marks.
That feels harsh. You did all the statistics right. You understood the concept. You just rounded wrong.
But in the real world, precision matters, doesn't it? If you're calculating risk for a $1 billion portfolio, that rounding error isn't just a decimal point. It's millions of dollars.
Fair enough.
The lesson here isn't about math. It's about attention to detail.
Read the instructions. Okay, let's move to example 2. We're leaving the boardroom and hopping on a bus. Corey Co.
Yes, service costing. This one is deceptive. The math looks incredibly easy, but the logic is slippery.
So we have a bus, runs 10 journeys a day. Each journey is 20 kilometers. And the daily operating cost is $1,400.
And the mission is to find the cost per passenger kilometer.
I love this metric. It's the great equalizer. It's the only way to really compare a bus to a train to an Uber. How much does it cost to move one body 1 kilometer?
Exactly. So what's the denominator? How many passenger kilometers are we dealing with here?
Well, first I need the distance. So 10 journeys times 20 kilometers. The bus travels 200 kilometers a day.
Correct. Now, how many people are on the bus?
The data says, well, it varies. For 30% of the day, that's peak time. There are 35 passengers.
Okay.
But for the rest of the day, the other 70%, it's off-peak and there are only 10 passengers.
This is it. This is where the trap snaps shut.
Okay.
Because a huge number of candidates, they'll look at the capacity, or maybe they'll just...
Take a simple average.
Exactly. A simple average of 35 and 10, which is 22.5, but you can't.
Because the time isn't split 50-50, you need a weighted average.
Precisely. You have to weight it by the time spent in each state.
Okay, let's do that. So 30% of 35 passengers, that's 10.5. And 70% of 10 passengers is 7. So 10.5 plus 7. The average load on that bus is 17.5 people.
So on average, you were moving 17.5 people across those 200 kilometers.
200 times 17.5 is 3,500. So that's our total output, 3,500 passenger kilometer.
And the cost was $1,400.
So $1,400 divided by 3,500 comes out to exactly 40 cents.
And there you have it. The reason people fail this isn't because they can't multiply. It's because they can't construct the model in their head.
It's cognitive laziness.
Yeah.
Your brain just wants the shortcut. Give me the average, but the shortcut is wrong.
And the reasonableness check is huge here. You know, if you did the math wrong, say you multiplied instead of divided, you might end up with a cost of, $400 per kilometer.
Right.
You have to stop and think, wait a minute. Does it cost $400 to move one person 1 kilometer? No, that's a private jet, not a bus.
I think that is the biggest takeaway for me so far. Stop and ask, is this number insane?
It saves more exams than you'd think.
Okay, let's shift gears. The next one isn't a calculation. It's more of a vocabulary test, but a tricky one. We are talking joint and byproducts.
Right. This is manufacturing accounting. What happens when you throw raw materials into a machine and 2 different things come out?
I'm going to throw 4 statements at you from the exam.
Oh,
This was a true-false section. You tell me if it's true or false, and crucially, why.
I'm ready.
Statement 1. Byproducts should be costed separately.
False. Straight up, false.
That.
Think of a lumber mill.
Yeah.
You cut down trees to make planks. That's your main product.
Yeah.
But you also create sawdust. That's the byproduct.
Yeah.
You don't waste your time trying to calculate exactly how much electricity and labor went into making the sawdust. It's not worth the effort. You just take whatever you get for selling the sawdust and subtract it from the cost of making the planks.
Makes sense. Okay, statement 2. Joint products have a substantial sales value.
True. That's the definition. If you're refining crude oil, you get petrol and diesel. Both are valuable. Both are the point of the exercise. They're joint products.
Leading nicely into statement 3. Byproducts have no value.
Also false. They have some value. You can sell the sawdust for animal bedding or fuel. If it had no value, it wouldn't be a byproduct. It would just be garbage you have to pay to haul away.
Got it. So it's a spectrum. Waste has a negative value, byproducts have a low value, and joint products have a high value.
A perfect summary.
Last one. Statement 4. Joint products are identified at the separation point.
True. The separation point is that magical moment on the factory line where the raw goop turns into distinct things. Before that, it's all one cost. After that, you can see product A and product B.
This section seems a lot easier than the math.
It is easier if you know the language. The problem is, candidates skim the textbook definitions. They think, yeah, joint products, I get it. But then the exam asks a specific nuance about separation points, and they just They waffle.
Let's move to example 4. This one.
Oh.
This one hurts. This is the compound interest trap, and I have to admit, when I read this in the prep notes, I fell for it.
You are in good company. This is probably the single most common gotcha in financial math.
So the scenario, you invest $5,000, you leave it alone for 2 years, the interest rate is 1% per month, compounded monthly.
Straightforward.
The question asks, calculate the interest receivable at the end of 2 years.
Okay, walk me through your instinct.
My instinct is to grab the formula. A equals P times 1 plus R to the N. So principal is 5,000, rate is 0.01, time is 24 months.
So far, so good.
So I calculate 5,000 times 1.01 to the power of 24. I punch that in, and I get $6,348.67.
And if you put 6,349 in that box,
You get 0 marks.
I feel, yeah.
Oof, because I didn't read the actual question.
You didn't read the question. You calculated A, the total amount, the accumulated fund. The question just wanted the interest receivable. It just wants the growth.
It's so subtle. I'm so happy I got the complicated compound interest formula right that I forget the simple subtraction at the end.
It's the victory lap problem. You solve the hard part, you feel good, and you spike the football before you cross the end zone. You have to subtract the original $5,000. The answer is $1,349.
This brings us back to what you said at the start. This isn't a math test, it's a reading comprehension test.
Exactly. It's simulating a client request. If a client asks, how much profit did I make? And you tell them their total revenue, you fundamentally misunderstood their question.
Okay, example 5. We're getting into the heavy machinery now. Marginal costing and variance analysis. The title alone sounds intimidating.
It scares people, but let's demystify it. It's really just a detective story. You have a budgeted profit, what you thought would happen, and an actual profit, what did happen. Variance analysis is just the investigation into why they're different.
Okay, so we're looking at a company called Crovico. We need to find the actual profit. The exam gives us a starting number. Standard contribution from actual sales is $88,000.
Think of that as our baseline. That's the money we made on the units we sold before paying the fixed bills.
Then we have the clues, the variances. First, sales price variance is $8,000 favorable.
Favorable. That's the magic word. It's good news. We sold our stuff for more than we planned, so that $8,000 goes into the pot. We add it.
Next, total variable cost variances are $5,810 favorable.
More good news. We spent less on materials or labor, so we add that $5,810 to the pot, too.
Third clue, fixed overhead expenditure variance is $3,900 in theirs.
Adverse is bad. We overspent on the rent or the electricity, so we have to subtract that $3,900.
Okay, so I'm doing the math. Start with $88,000. Add $8,000. Add $5,810. Subtract $3,900. So my calculator's saying $97,910. Is that my profit?
No.
Oh, come on. Why? I did all the variances. They were perfect.
You did. But look at the starting number again. Standard contribution. Contribution is revenue minus variable cost. You haven't paid the rent yet.
But I subtracted the rent variance, the $3,900.
You subtracted the extra rent you paid,
Right.
the overspend. You haven't subtracted the original rent bill.
Ooh, that is sneaky.
It's not sneaky, it's marginal costing. In marginal costing, fixed costs are a period cost. They have to be deducted in full at the end. And the report tells us the budgeted fixed overhead was $50,000.
So I need to take my $97,910 and subtract that huge $50,000 bill.
Correct.
So the actual profit is $47,910.
Doom. This is the forest for the trees problem. You get so obsessed with the little variances, the $3,000 here, the $5,000 there, that you forget you still have to pay the main $50,000 bill.
I can see why people crash on that. You're deep in the weeds of variance analysis and you forget the basic structure of a P&L.
Exactly. Always ask yourself, have I deducted the fixed costs? If you started with contribution, the answer is probably no.
All right, final example. Example 6. We are leaving the for-profit world entirely. We are going to a publicly funded hospital.
This is a great way to end because it strips away the dollar signs. The question asks, what are the problems with measuring performance in this hospital?
And it gives 2 options. Option 1, multiple conflicting objectives.
So think about a hospital. What's the goal?
To cure people.
Okay. What else?
To stay within budget.
What else? To minimize waiting times, to have the best technology, to treat the most people.
I see the problem. If I want to treat the most people, I might have to rush them, which hurts the cure people goal.
Right.
If I want to stay in budget, I can't buy the best technology.
Exactly. In a business, the ultimate tiebreaker is usually profit. Yeah. In a hospital, there's no single tiebreaker. The objectives fight each other. So option 1 is definitely a problem.
Okay. Option 2, measuring the value of outputs.
This is the classic public sector dilemma. If Toyota makes a car, the value of that output is, say, $30,000. The market sets a price, but if a hospital, sets a broken leg, what's the value of that? They don't charge the patient at the door. There's no price tag.
Well, yeah, the value to me is I can walk again, but how do you put that on a spreadsheet?
You can't, not easily. So measuring efficiency becomes incredibly hard. You can measure the inputs, doctor salaries, medicine, but you can't really measure the value of the output in the same currency.
So the answer is both 1 and 2 are problems.
Correct. And this requires the candidate to step back and think philosophically about what value actually means.
So we've done the autopsy. We've seen rounding errors, weighted average traps, reading comprehension fails, lost fixed costs.
What's the diagnosis? If you could sum up the examiner's advice, what would it be?
Well, the report concludes with 3 big pieces of advice. First, breadth. You can't question spot. You can't just study the stuff you like and hope the rest doesn't come up.
Right.
The exam covers everything from high-level hospital strategy to nitty-gritty rounding of decimals.
Practice the number entry. This is psychological. When you have a multiple choice question, you have a safety net. If your answer isn't one of the options, you know you're wrong and can try again.
But with number entry, you're just staring at a blank box.
Exactly. If you get 0.13, you type it in. There's no feedback loop. You need to be confident in your calculation steps. So practice doing questions without looking at the options.
And the third?
The reasonableness check. We talked about this with the bus. Always look at your final number and just ask yourself, is this stupid?
Does a bus ticket cost $400?
Did I just say I earned more interest than my initial investment? If the answer is yes, don't submit it. Stop. Reread.
What sticks with me is that initial stat. People are better at the stories than the math. It feels like we're in an era where we consume a lot of information. We know the buzzwords, we know the concepts, but we're losing the ability to sit down and do the dirty work, to actually crunch the numbers.
I think that's right. It's the difference between watching a cooking show and actually baking a souffle. The theory is fun, the practice is messy, and the exam, and frankly, the job is all about the mess.
Well, hopefully this deep dive helped clear up some of that mess for you. Whether you're taking the FMA or just trying to figure out the unit cost of your own habits, watch out for those traps.
And read the question twice.
Thanks for listening. We'll see you on the next deep dive.